Hello learners, my name is Amit Kumar and today we shall be discussing session 5 of the chapter Profit and Gains of Business or Profession. So in the previous session, in session number 4, we covered section 35 capital ABA, amortization of a spectrum fee for purchase of spectrum. Then we discussed section 35 capital ABB, amortization of telecom license fees. Then we discuss section 35 capital AD, deduction in respect of expenditure on a specified business. Then we discuss section 35 capital D with rule 6AB, amortization of certain preliminary expenses. Then we discuss section 35 capital D, amortization of expenditure in case of amalgamation or demerger. Then we discuss section 36, deduction which are specified under section 36. Then we discuss section 37, in which we discuss some general deduction which are available. And then we discuss section 37 capital B, instances of expenses not deductible. So today we shall be discussing some specific disallowances. That means there are some amount which are not allowed to debited to profit and loss account. So in this, first we shall discuss section 40 clause A. So nature of expenditure which is covered under section 40 clause A is interest, royalty, fees for technical services payable outside India or payable to a non-resident. So disallowance is as follows: condition for deducting TDS by the SSE, interest, royalty fees for technical service is being paid, amount is chargeable to tax in India in the hands of the recipient, amount is paid or payable to a non-resident. So these are the conditions. So if there is default in deducting TDS or after deduction has not been paid before the due date is specified under section 139 subsection 1, the expenditure is disallowed. So if the TDS is not done or it is not deposited before the due date of filing income tax return, then expenditure will be disallowed. However, if later on tax is deducted in any subsequent previous year or deducted during previous year but paid after due date, then such sum shall be allowed as deduction in which such tax has been paid. Next section is section 40 clause A, clause 1A. Nature of expenditure which is covered under this section is payment / credit of interest, commission, rent, technical / professional fees, royalty or contract payments are given to a resident. Disallowance: if there is default in deducting TDS under section 192 to 194 capital LA or after deduction has not been deposited on or before the due date specified under section 139 subsection 1, the expenditure is disallowed to the extent of 30% of such sum payable to the resident. However, if later on tax is deducted in any subsequent previous year or deducted during previous year but deposited after the due date, then such sum of 30% shall be allowed a deduction in which such tax has been paid. Next section is section 40 clause A, clause C. Nature of expenditure which is covered under this section is TDS default when salary is paid to a non-resident or outside India. Disallowance: no deduction shall be allowed if TDS is not deducted or paid on. Date of deduction of tax or due date is immaterial. Next is section 40 capital A subsection 2. So expenditure which is covered under this section is excessive or unreasonable payment to relatives / interconnected concerns. Disallowed: any payment made to certain specified person in excess of fair market value of the commodity, service or facility or legitimate need of the business or benefit derived by accruing to SSE as a result of the expenditure to the extent payment is considered as excessive or unreasonable, it will be disallowed by the assessing officer if not satisfied. A specified person include relative, director of company or director's relative, payment made by firm / association of person / Hindu undivided family to a partner / member or relative of partner, payment made to an individual who has substantial interest in the business of the pair or relative of such individual are also included in a specified person. This list is not exhaustive. That means any other person can also be included in this list. So this deduction disallowed the expenditure which is paid to relative to provide the benefit, indirect benefit. Relative means husband, wife, brother or sister, or any lineal ascendant or descendant of that individual. Substantial interest means a person having at least 20% of equity capital in case of company, or such person hold the 20% of profit of concern at any time during the previous year. Then we have section 40 capital A subsection 3 clause A. Nature of expenditure. Disallowance of expenditure exceeding rupees 10,000 paid by mode other than account paying check / draft. Disallowance. SSA incurs any expenditure of which payment, single or in aggregate, is made to a person in a day otherwise than by an account pay check / draft drawn on a bank or use of electronic system through a bank account rupees 10,000, then no deduction shall be allowed in respect of such expenditure. So if payment is made in any subsequent assessment year and expenses was allowed as deduction in any earlier year, then the SSE therefore made the payment otherwise than by an account pay check or draft drawn on a bank or use of electronic system through a bank account exceeding rupees 10,000, then such payment shall be deemed to be the profit of the year under profit or gains of business or profession in which such payment is made. In case of payment for plying, hiring or leasing goods carriage, this limit of rupees 10,000 is raised to rupees 35,000. However, as per rule 6DD, even exceeding rupees 10,000 / rupees 35,000 shall be allowed as deduction even if payment is made to a person in single or aggregate by other mode than check / draft. So payment made to the following shall be allowed as deduction even if it is paid in cash. So first is payment made to bank, for example RBI, SBI, Cooperative Bank, Land Mortgage Bank, any primary agriculture credit society and LIC. Payment made to government, whether it is central government or state government. Payment made through banking system, that means letter of credit, mail or TT through bank, bill of exchange, electronic clearing system, credit / debit card. Payment is made by way of adjustment against the amount of any liability incurred by the payee for any goods supplied or services rendered by SSE to such payee. Payment is made to the cultivator for purchase of agricultural produce, produce of animal husbandry or poultry farming, fish or fish products, or the product of horticulture or apiculture. Payment made to a producer for the purchase of the products manufactured or processed without the aid of power in a cottage industry. Payment made to a person who resides or carries on business in a village not served by bank. Payment of terminal benefits, for example gratuity, retrenchment compensation, etc., not exceeding rupees 50,000. Payment made on the date of closing of bank due to holiday or strike. Payment made by any person to his agent who is required to make payment in cash for goods or services on behalf of such person. Payment made by an unauthorized dealer or a money changer against purchases of foreign currency or traveler check in the normal course of business. Payment made by way of salary after deducting tax made to such SSE who is temporarily posted for a continuous period of 15 days other than normal place of duty or on a ship and does not maintain account at such place or ship. Then we shall discuss section 40 capital A subsection 7. Nature of expenditure which is covered under this section is provision for gratuity. Disallowance. If gratuity is a payment made according to the length of the service, not deductible, only approved gratuity fund is deductible. Section 40 capital A subsection 9. Nature of expenditure. Employer's contribution to non-recognized fund or trust. Disallowance. If it is not allowed as deduction but employer's contribution to recognized provident fund, statutory provident fund or approved superannuation fund or approved gratuity fund is allowable deduction. Next section is section 43 capital B. Nature of expenditure. certain deductions to be allowed only on actual payment. So in this section, we shall be discussing some expenses which will be allowed to debited to profit and loss account if they are paid on or before the due date of filing income tax return. So disallowance, deduction in respect of certain expenditure / payment is allowed only if the amount has been paid during the previous year, irrespective of the previous year to which the liability to pay was incurred. If SSE follows the mercantile system, the following payments can be claimed on due basis provided the payment is made within the stipulated period. Any sum payable by way of tax, duty, cess or fee or whatever name called. Any sum payable by an employer by way of contribution to provident fund or superannuation fund or any other fund for the welfare of employee. Any sum payable as bonus or commission for services rendered to an employee. Any sum payable as interest on loan or borrowings from public institution, that means ICICI Bank, IDBI Bank, IFCI, DFC, etc. Any sum payable as interest on loan or advance taken from a scheduled bank or cooperative bank. Any sum payable by an employer in lieu of leave at the credit of his employee. Any sum payable to the Indian Railways for the use of railway assets. So the above expenses are deductible in the year in which payment is actually made. If the aforesaid payment is actually made on or before the due date of submission of return of income under section 139 subsection 1 in respect of previous year in which the liability to pay such sum was incurred, then it will be allowed in the same year. If it is not paid before the due date of filing ITR, then it will not be allowed to debit it to profit and loss account. So if the payment is made after due date, deduction can be claimed in the year of payment. So if the payment is not made till the due date of filing ITR, then SSE can claim the deduction in the subsequent previous year. Now we shall discuss deemed profits chargeable to tax. The following receipts are chargeable to tax. Number 1, recovery against any deduction which is defined under section 41 subsection 1. So in case a deduction was allowed to the SSE in any previous year on account of loss, expenditure or trading liability incurred, and during the current year the SSE has obtained a refund of such loss or expenditure or has obtained some benefit in respect of such trading liability by way of remission or cessation thereof, then such amount obtained shall be deemed to be the profit and gains of business and profession and are chargeable to tax as the income of that previous year. Even if business is not in existence in the year of recovery, it shall be taxable. In case of amalgamation / demerger, it shall be taxable in the hands of successor. For example, if rupees 1 lakh is paid as sales tax during the previous year 2019-20 and the same is allowed at deduction, the SSE claims a refund of rupees 10,000 on June 2020 after a court case decision. The same is rupees 10,000 shall be taxable in the previous year 2020-21. Next, sale of assets used for scientific research, section 41 subsection 3. So asset is sold without being used. So we have already discussed this section in the section 35 when we discuss expenditure on scientific research, section 35. So asset is sold without being used for other purposes. Net sale price of the assets or cost of the asset which was earlier allowed as deduction under section 35, whichever is less, shall be treated as business income of the previous year in which asset is sold. So any capital gain, that means sale price minus original cost, will be liable to provisions of capital gain. This provision will apply even if business is not in existence in that previous year. Recovery out of bad debts, section 41 subsection 4. So if any amount has been claimed and allowed as a bad debt, then if the amount is subsequently recovered, it shall be treated as the income of the previous year in which it is recovered. Business may or may not be continued in the previous year in which it is recovered. The amount withdrawn from a specific reserve created and maintained by certain financial institutions. Section 41 subsection 4a. So if any amount withdrawn from reserve subsequently, then it shall be deemed to be profit and gains of business and profession are chargeable to tax as the income of that previous year. Recovery after discontinuance of business or profession, section 176 subsection 3 capital A. So any sum received after the discontinuance of the business or profession it shall be deemed to be profit and gains of business and profession are chargeable to tax as the income of that previous year. So now we shall be discussing how can we calculate the income which is taxable under the head of PGBP. So computation of profit and gains from business or profession. So first of all, we will take the profit from profit and loss account which is prepared by the SSC. So balance as per profit and loss account. Then we will add expenses claimed but not allowed. So first of all, we will add the expenses which are debited to the profit and loss account, but they are not allowed to debit as per the provisions of the Act. So all provisions and reserves, all taxes except sales tax, excise duty and local taxes of premises used for business, rent paid to self. So rent paid to self is not allowed to debit to the profit and loss account. So we will add back all capital expenses except on scientific research. So if the capital expenses is debited to profit and loss account, we will add back that amount because we will charge depreciation on that capital expenditure under section 32. All capital losses, all charities and donations, all expenses relating to other heads of income, any interest on capital unless the amount is borrowed, any personal expenses, for example drawing, etc., any depreciation if wrongly debited, gifts and presents, any type of fine or penalty, any payment to a partner in case of firms only by way of salary, interest, bonus, commission or remuneration excess over prescribed limits. Past losses, salary paid to self or other members of family, personal life insurance premiums, speculation loss, bad debts still recoverable, legal expenses on criminal cases, acquiring title of an asset, loss by theft from residence, employer's contribution to unrecognized provident fund, expenses disallowable under section 40 and 40 capital A, preliminary expenses being capital expenses, amount to be treated as income though not credited to profit and loss account. So we will add back all these expenses because they are not allowed to debit it to profit and loss account. Then we will reduce the amount credited to profit and loss account but not to be included under this head. So if any amount which is credited to profit and loss account but it is not allowed to credit as per the provisions of the Act, then we will reduce it from the profit. So the item which are covered here is actual bad debts not charged to profit and loss account, depreciation not charged to profit and loss account, difference due to under debiting of stock. Then we will reduce expenses which are allowable but have not been debited to profit and loss account. So there may be some expenses which are allowed to be debited to profit and loss account as per provisions of the Act, but they are not debited, and any income exempted from tax or taxable under other heads. So post office saving bank account, agriculture receipts, gifts from relative, income tax refund, bad debt recovered, disallowed earlier, any capital receipt, interest on securities, rent from house property, let out, capital gains, dividend, bank interest, winning from lotteries, race, horses, etc. So after that we will have the profit which will be taxable under the head of profit and gains and will be included in the gross total income of the SSC. So now we shall discuss illustration. So Miss Sanchita Krishnamurthy, 45 years old, is a businesswoman and resident in India. So profit and loss account for her business for the previous year 2020-21 is as follows. So Miss Sanchita is running a business and she has given you the profit and loss account which she has prepared. So on the debit side, first of all come to the credit side. On the credit side we have gross profit of 6,80,000. Then we have profit on sale of shares 26,000. So profit on sale of share is not allowed to credit it to the profit and loss account because it is the income which is taxable under the head of capital gain. Commission and discount 1,85,000 and other receipts 52,000. The expenses which are debited to profit and loss account are insurance premium for factory 42,000, bad debts return of 20,000, interest on Miss Sanchita's capital 4,000, interest on bank loan 15,000, advertisement expenses 6,500, reserve for losses 35,000, paid for copyright on 10th February 2021 45,000. So paid for copyright, it is a expenditure which is of capital nature, so it will not be debited to the profit and loss account. We shall charge the depreciation for this. provision for outstanding GST 15,000, expenditure on a patent. So she has taken a patent right and she has incurred the expenditure of rupees 55,000 and it is put to use on 10th November 2020. So it is also not allowed to debit it to profit and loss account because it is a capital expenditure. We shall charge depreciation on this amount under section 32 at the rate of 25%. Depreciation on plant 32,000, other general expenses 58,000, salary to staff 2,60,000, and the net profit which comes out is rupees 3,55,500. So this is the profit and loss account which is prepared by Sanchita, and as per her, according to her, her profit is 3,55,500. So there are some additional information which is given. First, depreciation on plant as per section 32 is rupees 25,000. Outstanding goods and services tax liability of rupees 5,000 was paid on 10th July 2021 and of rupees 6,000 was paid on 15th September 2021 and the balance has not yet paid. Other general expenses include the gift of rupees 14,000 paid to Ms. Sanchita's brother on his birthday. Salary paid to staff includes rupees 15,000 paid to relatives of Ms. Sanchita, out of which rupees 10,000 is unreasonable. Other general expenses includes a cash payment of rupees 17,000 made on 10th August 2020. So you have to find out the income under the head of profit and gains of business or profession for the assessment year 2021-22. So we will find out the profit taxable under this head. So first of all, we will take the profit which is calculated by Sanchita and we will add or less the amount which is not allowed to debit it or credit it to the profit and loss account. So the profit as per profit and loss account is 3,55,500. First we will add interest on Ms. Sanchita's capital because it is not allowed to debit it to the profit and loss account and she has debited. We will add back this amount. Then we will add payment for copyright. So the payment for copyright is the expenditure of capital nature. It is not allowed to debit it to the profit and loss account. So we will add this amount 45,000 and then we will charge depreciation on copyright. So rate of depreciation will be 25% and copyright is put to use for less than 180 days. So we will charge depreciation which will be half of the normal rate of depreciation. So the amount of depreciation will be 5,625. Then we will add outstanding GST expenditure disallowed under section 43 capital B because the expenditure of rupees 10,000 was not paid till the due date of filing ITR. So you can see in point number 3, in point number 2, outstanding goods and services tax liability was rupees 15,000 but only 5,000 was paid on or before the due date of filing ITR. So it was paid on 10th July 2021. So only 5,000 will be allowed to debit it and the rest 10,000 we will add back. Then we will add expenditure on patent right because this expenditure is also of capital nature. We will add back the amount of rupees 55,000. Then we will reduce the depreciation on patent right. So rate of depreciation will be 25% but it is put to use for less than 180 days. Then we will charge half the rate of depreciation. So the amount of depreciation which is allowed to reduce is 6,875. Then we will add excess depreciation on plant 7,000 because she has debited the depreciation on plant which is equivalent to 32,000 but as per the Income Tax Act only 25,000 is allowed to debit it. So we will add the excess amount which is 7,000. Then we will add gift paid to brother. Personal expenses are disallowed. So she has paid gift to her brother on his birthday and she has debited this expenditure in profit and loss account and it is not allowed to debit. So we will add back rupees 15,000. Then we will add payment made to relative which is unreasonable to the extent of rupees 10,000 because it is not allowed under section 40 capital A subsection 2. Then we will less profit on sale of shares because it is the income which is taxable under the head of capital gain. So it is capital gain income, not game income. It is capital gain income. We will less this from the profit 26,000. Then we will add cash paid for expenditure which is disallowed under section 40 capital A subsection 3. So 17,000 is paid in a single day on cash basis, so it is not allowed to debit it to the profit and loss account. We will add back this amount 17,000. So after adding and reducing all the amount, the taxable amount of profit will be 4,80,000. Thank you.